2021 market report is inflation, friend, foe, or figment of the market's imagination. In this article, we cover why inflation is important. And the reason is, quite simply, that the world can't afford higher interest rates with the degree of indebtedness that exists across most countries. So we'll either have debt defaults or major recessions if inflation spikes out and interest rates happen to follow. What we also cover is, what the real factors of inflation are over time. And there are effectively 6 major drivers of inflation. Some are transitory and others are more permanent. And it's the permanent ones that we need to worry about. But the market seems quite obsessed with inflation, and a lot of the factors seem to be actually quite transitory. So the first of those is oil. We go back to the 1970s, 40% of inflation adjustments or price rises tend to be oil related. This is particularly relevant in the developed world. Food is the second one, and that's particularly important when it comes to the emerging markets. So we've seen a dramatic spike, more than 20% increase in food and oil prices since the start of the pandemic, and commodity prices as a whole are 30% higher. So certainly these are important points and definitely inflationary, but they are transitory of nature. And through time from the 1970s, all these influences have tended to move out of the system within a year or two. Then the third is demand shocks. Demand shocks account for about 40% of inflation adjustments over time. And the demand shock is really just a sudden or dramatic increase in demand in the system. And if we look currently where that's coming from, the big fiscal adjustments taking place, the fiscal stimulus is certainly causing a demand shock in some of the economies. Take the US, for example. The current $1.9 trillion that's been injected in the fiscal stimulus into the system accounts for about 27% of annual GDP. But what the market's failing to really look at is that inflation existed within the COVID time period, and particularly around certain consumer goods. Being home-based, people consumed a lot of these products and prices rose. Against that, we've seen deflation in services. So when things normalize, clearly service inflation will rise. But equally, we could see compression in prices of the very products that rose during the COVID virus. So there could be some net off effects in terms of inflation. But demand shocks too tend to be transitory of nature. Then output gaps. Output gaps are really the extent to which the economy is operating at full employment. And if we look across economies globally at the moment, they're far off operating at full employment. In fact, there's negative output gaps. And we're seeing that in Europe, currently in the US. In the US, that should close within the next year. But in Europe and other countries around the world, it will take a year or two for output gaps to close. So at the moment, that's more deflationary than inflationary. One of the real bugbears, and for the proponents, the inflation proponents, is excess money supply. And there's really no doubt that we've seen a dramatic increase in the amount of money printed and placed through the system, not just physical money, but the virtual money supply has risen globally. In fact, just in the last year, 20% of all dollars were created. And in theory, this should lead to higher demand, but only through the transmission mechanism that the banks must extend loans. And to date, we've seen no large extension of loans into the system. And that might change in time, but right now, inflation is certainly not being stoked by excess money supply. And it hasn't been the case since the GFC in 2008. So there's been no relationship between rising money supply and inflation heading higher. And until that changes, there's no proof that that's actually inflationary. And I think really the last 6th point that we think is critical is psychology. Inflation is a human behavior. It's driven by human activity. And inflation expectations are a key driver, or deflationary expectations are a key driver of price movements in the future. So the Fed is desperately trying to anchor inflation expectations around 2%. And if we've looked at this last week, they came out with their minutes, and we saw Governor Powell indicating exactly what their view would be on inflation in the year ahead. They believe that we'll hit 2.4% in 2021, which will then narrow to about 2% in 2022 and then slowly head higher thereafter. We think that's quite an accurate assessment of where inflation will end. And we do believe that none of the factors currently that are driving the spike that we're seeing, including certain supply side adjustments, are permanent of nature. In fact, there's no evidence to prove that they're anything but transitory. When we start to see inflation expectations rise on a larger scale, and none of the surveys show that, then we can start to think about longer dated secular inflation increases, which is not the case at the moment.